Good morning, Krish, and good morning, Louise. We are hugely honored to have you both presenting the outlook for gold in 2022 for our Auctus Metal Portfolios clients. We, of course, understand that gold is the prerequisite monetary lifeboat, so to speak, and must be thoroughly understood and studied by investors to not only indicate underlying trend directions for precious metals in general, but as a clear macro fundamental indicator. Who better than the World Gold Council, therefore, being the global experts on gold, to help our clients improve their understanding of the gold market and leveraging your broad knowledge and global experience. A quick introduction to you both, if I may. Louise Street, you joined the World Gold Council in 2008 and work in the research team as the lead analyst, and also produced the hugely popular Gold Demand Trends Report, which I have circulated to all of our clients, being the foremost industry publication on gold demand and supply. You are also responsible for generating and writing research pieces, managing consumer research projects, and engaging with gold industry stakeholders, as you are going to do today. And Krishan, Gopaul, you similarly joined the World Gold Council in 2011 and also work in the research team as the senior analyst for Europe, the Middle East, and Africa. And you are likewise tasked with generating and writing research pieces, managing key data sets, and engaging with industry participants and investors. I will hand over to you both now.
Thank you very much, Robbie, and thank you, David, for having us on your presentation today. We hope that you'll find the insight that we provide to you and your audience on gold will be incredibly useful. And afterwards, we'd be happy to field any questions that the audience might have. So today's title is the Gold Outlook in 2022. But before we get on to that, I will just start with explaining who the World Gold Council are. You gave us a brief introduction, but to go into a bit more detail for those who are less familiar, we are the global experts on gold. We're a market development organization founded in 1987, and we're an association of members, and our members are some of the leading global gold mining firms with operations in over 45 countries. Now, what we tend to do, or we try to do, is we leverage our broad knowledge and experience to enhance the understanding of gold and the value that it can bring to individuals, to investors, and the world at large. Some of the work that we have done involves developing standards for markets and the global gold market, working to enhance and expand access to gold, and tackling barriers where the stimulation of gold demand is less easy. And we do this with the aim of sustaining and supporting a vibrant gold market for all across the world. And here we've got some of the key kind of achievements that we have made over the last 30 so years that the Gold Council has been in existence. So before we get on to the outlook, we'll just give a very brief overview of gold as a whole. So let's take a step back and take a look at the gold market. So typically when people think of gold, they think of it as an investment asset. And this is primarily led because this is where price discovery happens. So understandably, investment related variables will have a big impact on how gold performs. However, we shouldn't forget that the gold market is split into several different sectors. We have jewelry and technology, which are typically the consumer side of the market, the investment side that we've already spoken about, and central banks. Now, these four sectors combined play incredibly important roles in how gold behaves. And this is something that we deem as, and by this we mean that gold performs not only as an investment asset, but also as a consumer good as well. Now, this leads to its behavior being slightly different from other metals and other assets, in that it brings a level of stability that you may not see. And this is due to these sectors that we have spoken about having different characteristics. So investment, for example, will typically be counter-cyclical. So as we see risk and uncertainty increase, as we have done for the last several years, we will see investment in gold tend to rise. Now, On the other side, on the consumer side of the market, so jewelry, for example, that tends to be pro-cyclical. So as people get wealthier, if economic growth improves, we tend to see demand for jewelry actually increase. And so this counter-cyclical and pro-cyclical elements of the gold market and gold demand actually brings a level of stability that you may not see elsewhere, and is what we describe as its dual nature. Now, we also have what we call our strategic case for gold. So this is zeroing in on gold's role as an investment asset and a portfolio diversifier. So there are three key pillars, the first of which is returns. Now, as a non-yielding asset, many investors believe that gold simply doesn't provide a return. Now, this is something that our research has shown is not true. So over the last 50 years or so, since the fall of the Bretton Woods, gold has returned on average about 11% in US dollar terms every year. Now, that's comparable to equities and in some cases higher than bonds. So it's really important to understand that gold isn't simply a defensive asset. It can help capital increase or grow, not just work as a capital preserver. So that's the first pillar. The second pillar is diversification. Now, effective diversifiers are incredibly difficult to find. Now, by effective diversifiers, we mean those that will protect investors in both bad times, but also be useful in good times. Now, as you can see from this chart, looking at gold in particular, and here we have it compared to commodities, we'll see that overall gold has a very slight positive correlation to all returns from the S&P. But critically, when we see the S&P decline here by 2 standard deviations or 3 standard deviations, the correlation that gold has with equities becomes progressively more negative. So when things get worse, gold actually provides that additional diversification benefit that we would by operating in the inverse. Whereas commodities, as you can see, their correlation to the equities actually increases as equities go down further and further. The third pillar is liquidity. Now, gold is an incredibly liquid market. $131 billion a day last year. And again, that's split up over the counter, futures and exchange traded products. So it makes for incredibly liquid market that investors can have that kind of reassurance that they're able to get in and out of the market with minimum fuss. And as you can see on the chart, gold is actually as liquid as many of the major markets that investors consider in their portfolios, which again is a huge benefit to a diversifier, which may be needed in times of crisis. So these are the 3 key pillars, so returns, diversification, and liquidity. And these are our core, as I said, pillars to our strategic case, and why we believe gold is a very unique asset in terms of its portfolio attributes, and why we feel that most, if not all, investors should consider gold as part of their overall portfolio. So that's a quick overview of the gold market and its strategic case. We'll look at gold more recently, and so in the last 6 months, and we are showing a chart based on our gold return attribution model, which is available on our website, goldhub.com. And what this does is it tries to attribute gold's performance to 5 or 6 broad key drivers, and tries to explain why gold has been forming as it has. And what we have seen over the last 6 months or so is that the interplay between inflation, which has been rapidly rising, not just in the US, but in Europe and more globally, has been competing with the increase or the potential increase of interest rates and yields that we've been seeing rising. So those 2 competing forces have been the primary drivers of gold over the last six months or so. And you can see that on this chart where we have the opportunity cost bucket, which is capturing that rates kind of factor, has become more prominent in recent months as the kind of central banks have become progressively more hawkish, and they have looked to increase rates. That has created a challenge, a headwind for gold. Whereas on the opposing side, the risk and uncertainty bucket is where we capture the inflation aspect in this model, and that obviously leads to a positive impact. So again, depending on which of the two primarily is dominating at any one time, will have a significant impact on how gold behaves. Now, we'll also notice there are other factors such as momentum, and we can see this in things like ETF flows. So in Q1, as Louise will discuss in a bit more detail, we saw significant inflows into gold-backed ETFs, and this was representative of a kind of a flight to quality. Investors were keenly aware of the risks that were increasing across the world, not just macroeconomic, but also geopolitical. And this led to a significant supportive factor for much of the first quarter. We also have an explained component, which captures what we don't capture directly in the model. And you'll see around January, February, and even into April, we see relatively significant grey bars representing that unexplained component. And a lot of this is down to that geopolitical uncertainty that I mentioned just a moment ago. The war in Ukraine obviously had a significant impact in the gold price earlier this year. So this is kind of the key drivers. So inflation, geopolitical risks, and yields have had the biggest impacts on gold's year-to-date performance. And that's something that we're continuing to see into May. Obviously, it's a very big day with the Fed announcement of their interest rate decision. So it will be incredibly important as we move through the rest of 2022 to see how these factors, so inflation and particularly yields, behave, as these will have incredibly important kind of influences on how gold ultimately behaves for the remainder of the year. But with that, I'll hand over to cover a bit more detail about the Q1 picture and then talk about our outlook.
Thank you.
Thanks, Krish. So just waiting for that next slide to load. I don't know if anyone else's screen is being as slow as mine. Okay, there you go. Good morning, everyone. So yes, as Robbie mentioned in his very kind introduction, we've just recently published our Q1 Gold Demand Trends publication, which looks at the preceding quarter, looks at globally and by sector what's happened in the gold market in terms of demand, takes a look at supply and gives a little bit of a broad kind of review and then an outlook for what we see happening over the rest of the year. And just in a nutshell, the sort of the top line key message from Q1 was that we saw a solid start to 2022. If we look at Q1 gold demand on a global basis, it was 34% higher than the first quarter of 2021. You can see that quite clearly in the bars on either end of that chart there. And really the main driver of that was, as Krish mentioned, the really strong inflows that we saw into gold-backed ETFs. If you look at the left-hand bar, you can see there were outflows in Q1 of 2021, and those had reversed, more than reversed, in fact, into some very strong inflows in the most recent quarter. And recently, really, that was being driven by, you know, this kind of upsurge in, obviously, the geopolitical tensions with the outbreak of war in Ukraine, and again, as Chris mentioned, you know, the rampant inflation, which was kind of playing on investors' minds. So we really saw that kind of surge of revival of inflows into ETFs on the back of those factors. Bar and coin investment, which is what we term retail investment, so literally sort of bars of a kilo and below and official coins. It was down year on year in the first quarter, about 20%, but it's important to bear in mind that it was being compared with a very strong base quarter in Q1 last year. We saw the price dip and we saw quite a lot of people buying into that. So we saw, and obviously kind of coming out of the lockdowns, we saw kind of a bit more of a relief buying at that time. But if you look at bar and coin demand on a much longer term basis, typical sort of average quarterly levels over the past 5 years, in Q1, the sort of most recent Q1, we were 11% above that long-term average level. So kind of comfortably higher than where we would typically be on a quarterly basis. And also, if you consider what was happening with the price, And in several markets with currency movements, we saw the gold price not only kind of surging in late February, early March, but in the currency effect in markets like Japan and Turkey, for example, multiplied that effect. And what that did was prompt either kind of some profit taking or just kind of made investors sit back and wait for prices to settle a little. So that kind of had an impact on the latest quarter as well. In terms of jewellery consumption, that also lost momentum in the first quarter. It was down 7% year on year, primarily due to India and China. If we take those two markets out of the global equation, the rest of the world was actually up 7% year on year. And given that we're looking at a quarter in which average prices were quite a lot higher than they were last year, that's quite an encouraging outcome. And obviously with China, the main impact there was the fact that we saw those lockdowns imposed in some pretty key cities, Shenzhen and Shanghai being kind of two really sort of key metros for the jewelry sector in China. So that had a big impact on jewelry consumption for the first quarter. And then finally, on the central bank side, we saw them continue buying in Q1. They've added 84 tons to global reserves, which was more than double what we'd seen them buying the previous quarter in Q4, but a bit less than we'd seen in Q1 of the previous year. So that's kind of just in a nutshell what we saw in terms of demand in the first quarter. And Krish, if you move forward on the slides, I can just take a quick look at what we think for the outlook for 2022. Waiting for that. Okay. So in terms of our outlook, there are sort of mixed prospects, and this relates back to what Krish was talking about in terms of gold's dual nature, and we often see those different kind of sectors of demand responding in different ways to kind of the macro economic environment. Should probably just briefly explain what the chart here shows. It's looking at the year-on-year change in tonnage demand or supply for each of those sectors. The red dot for each sector gives, it's not a forecast officially, but it's sort of the level that we're kind of most comfortable on the basis of our analysis, our modelling, and just kind of what we know and expect to happen. And then the bars represent obviously the sort of the potential range of outcomes for each sector, and the tail will indicate whether we're sort of a bit more comfortable with an upside bias or a downside bias for each particular sector. And you'll see pretty quickly that investment is kind of where we're seeing both the most positive potential outcome in terms of growth in 2022, but also the biggest range. And that really reflects what we're sort of terming this binary outlook in terms of the potential extremes in terms of outcomes for the year are pretty broad. So on the one hand, you've got the potential for those building stagflationary risks, capital market volatility, continued perhaps progressive war in Ukraine, the possible outcome that central banks sort of make a bit of a misstep in their interest rate rises, perhaps implement them too harsh and too fast and choke off some of the economic recovery that we're seeing. So that's kind of on the one hand the more investment positive scenario, if you like, that we would see. But on the other hand, you do have the potential for a swifter than expected resolution to war in Ukraine, potentially central banks managing that soft landing without too much detrimental impacts on economies. And in that situation, you'd see investment sort of softening. But we sort of erring on the side of the more positive outcome for investment for 2022, particularly given what we saw in the first quarter. And the continuing inflation build that we're seeing, the continuing war in Ukraine with kind of little sign of resolution. So that is our sort of bias for investment is positive for the year. On the more consumer side, sort of no surprise that given that more likely background being positive for investment, that it's somewhat weaker for the consumer elements of jewellery and technology. So we're seeing both of those a little bit weaker year on year with a bit more downside risk. While both sectors are benefiting from the continued recovery from the years of lockdown and the pandemic, there's obviously, we're seeing average higher gold prices. We are seeing a slowing in that economic growth. we've got the big sort of, the big unforeseen that came in Q1 was China's lockdowns, and those seem to be continuing. And obviously the impact that they will have going forward could be quite significant. So that's why they're sort of more of a downside risk for the consumer side of the gold market in 2022. On the central bank side, we still can see they're going to be net positive buyers, continuing the long-term trend that we see for them to add to their annual reserves. Worth noting that active management we see in certain countries, particularly those countries that are big domestic producers. It's not uncommon for them to take advantage of rises in the gold price and just be a bit more active in their buying and selling of gold. So that would be something that we could see continuing throughout 2022. And then on the supply side, on the recycling side, as we've got slowing economic activity this year, at the moment still, higher gold prices, providing that we've got enough near market supplies, we could see that recycling would respond to that environment by increasing. While on the mine production side, we've got continued improvements from ramping up of brownfield sites, and in particular, the continued return of China, which was very weak on the production side for safety related closures in much of 2020 and 2021. So that's the broad outlook that we see for the gold demand and supply dynamics for 2022. Just a brief mention on the next slide of the tools that we've got available on our website. As Chris mentioned, the gold return attribution model is something we've already looked at, which is really useful in terms of showing those drivers of gold price and the relative contributions that they make. But we've also got, we finally settle on the right slide, I think there's some issues with that going on at the moment, the quorum model, which is a framework or an interactive tool really designed to help address investors' need to be able to value gold, which is something that the kind of historically haven't had. It's a quantitative framework. It essentially allows you to generate scenario-based inputs, which will then provide demand and supply forecasts based on those inputs. You can either use the custom-based scenarios that Oxford Economics provided for us on the site, or customize your own sort of economic scenario that you see playing out over the next few years. And what that will then do is translate that into the impact on the various sectors of demand and supply. Obviously, knowing as we do kind of the various drivers that affect each of those sectors, it allows us to kind of, or allows the tool to quantitatively then say, these inputs will play out into this scenario for gold demand and supply. And what that can then do is to generate a implied return, long-term return for gold to see how that would play out. So that wraps up the official side of the presentation that we've put together. And now hand back to Robbie for any questions.
Yes, brilliant. Thank you so much both for your thorough presentations. And if I may, I will now put forward some questions which we received from our clients. I will address these to both of you, and you can decide who'd rather answer them. So the first question we have is, gold has historically been considered an inflation hedge, but hasn't really significantly responded recently price-wise to historically high global inflation data. Why might you suspect this to be the case?
Yeah, I'm happy to field that one.
Okay.
Yeah. So we did actually see a 8% increase in the gold price over Q1. Now that wasn't solely related to inflation, as we've already discussed. But I think it's important to understand that gold is, we should be best considered as a long-term inflation hedge. Now, it's also important to consider what we mean by inflation. So typically people will consider CPI as what is the measure of general price increases, and that's fair. However, our analysis has found that gold's relationship with CPI, particularly US CPI, is actually pretty weak. So we've found that it actually may be more useful to consider a more broad-based measure of increases in price, and we do that through money supply. Now, when you consider money supply, you are not just considering the rise in prices, but you're also considering a reduction in overall purchasing power. So it also means it's a more broad kind of based capture of the change in price level. It also allows you to therefore include things that aren't necessarily captured in CPI. And when we do consider this, we've actually found that gold actually performs quite well. It actually has kept up with the level of growth in money supply, kind of leading to the conclusion that actually it does, in the long term, provide that element of kind of protection against broad-based increases in money supply. So I think it's very difficult to kind of particularly zero in on the last quarter or the last year. What we've seen has been very, very rampant and a rapid rise in inflation to kind of multi-decade levels in many parts of the world. And I think it should also be considered that many investors, when looking for inflation protection, have a number of choices. It's not simply going to be gold. It's going to be, you know, inflation protected securities. It's going to be real assets. It's going to be commodities. And much of what we've seen in terms of institutional investment has been that actually, in order to kind of combat or protect their portfolios as best as possible from inflation, is that a broad basket of diversifiers or hedges are kind of what provides the best protection. And we do say also in our analysis that gold typically works best within a basket of inflation hedges, again, which we've mentioned. So there are a number of reasons why maybe some people will look at gold's performance in recent years when inflation started to really pick up, and think that maybe it should have done better. However, there's a bit more to consider. But as I said, over the long term, I think it's well recognized that the gold is actually a fairly effective inflation hedge.
I think it's probably worth just jumping in there as well to say, kind of reiterate the point you made, Chris, when you were looking at the price attribution, that, you know, the current environment is quite nuanced in that, yes, we've got historically high inflation, but that's also bringing with it the prospect of the most drastic action by central banks that we've seen, you know, in sort of recent memory. And that's coming after a time in which nominal rates have been zero, if not negative, and real rates sort of deeply negative. So I think, you know, as we've talked about, it's been that sort of push and pull between investors focusing on the rising inflation on the one hand, but also the prospect of these kind of almost unprecedented for many tightening of kind of interest rates. And yeah, there's been a bit of a whipsawing of those two. And I think that's definitely affected gold in terms of the sort of this flip-flopping of the main drivers of its performance.
Yes, and it must be said that the Federal Reserve also monitors this through broad money supply. They actually produce a chart on their website, and they divide it by their actual stockpiles of gold and present valuations of gold. If you were to look at this, then obviously gold is exceptionally undervalued and probably at record low valuations. It's exceptionally undervalued. So it has not kept in line with the monetary base increasing, especially over the last 43% over the last couple of years. So I think there is an extreme opportunity there. Do you monitor this from a money supply situation?
We have looked at gold against money supply within the context of our analysis. It's not something that we look closely at. We're obviously keenly aware of the unprecedented central bank actions, as Lou mentioned, that have happened over the last 3 or 4 years in terms of kind of the rampant increases in asset purchases, the long-standing, persistently low inflation environment, interest rate environment that we've had for several years now, and the low levels of interest rates. It's something that we do constantly monitor, you know, in a broad sense compared to, as Lou said, it's obviously very nuanced. This is several factors within a broad universe of factors that we look into, but it's absolutely critical in terms of what may come. So if we're talking about the outlook, how central banks unwind the policies that they've had recently will be incredibly influential, not just on gold, but I think the kind of markets in general. And so that's something that I think is kind of speaks to some of the drivers of gold investment that we've seen so far this year and more recently, and how that could play out in the future. Is that obviously that level of uncertainty, as Lou said, central bank missteps, not just in terms of interest rates, but also, you know, the reduction in asset buying, whether that will create any sort of additional asset price distortion, given that valuations are obviously incredibly high, and whether that will create any more market disruption or instability going forward, as that kind of supportive action, that accommodative policy is slowly withdrawn. So these are important factors to consider when looking at gold, and we do indeed look at them, but it kind of, they are one piece of a broader picture, as Lou mentioned.
Thank you. Moving on, question number 2. There has been a lot of conjecture recently about Russia using its gold holdings to underpin the value of the ruble. Is this really the case? And if so, how would this potentially impact the value of gold moving forwards?
So I think since the invasion of Ukraine, obviously the topic of Russia, its assets, and you know, the sanctions placed by Western countries, has been a huge topic of conversation. Russia is one of the largest holders of official sector gold reserves. And obviously these are typically fall outside sanctions, but obviously it can be restricted in their use. I believe what you're referring to is the reports that Russia were buying gold at a fixed price, I think of about 5,000 rubles. Now, I think that was a very temporary program. I think maybe about 2 weeks later that ceased, and it switched to a negotiated price. And the more recent stories about the Russian government talking about pegging to gold, the ruble to gold, I think was downplayed by the central bank. So these kind of reports we are monitoring. It's very difficult for us to talk about particular central banks and their actions. We obviously are keenly aware of what's going on in that sector. It's of a huge interest, not just to us, but to the wider investment community interested in gold. But we can't directly comment on those actions. I think what we've seen is a restriction in what Russia can do with its international reserves. But I think we have to wait and see how this continues to play out. We don't have any recent data since the end of January for Russian gold reserves, even though they indicated, I think, at the end of March that they would be buying, they would resume their buying program of gold. So we're kind of having to wait and see how this plays out. And until we get more information, I think it's quite difficult for us to kind of make any sort of assessment on what has happened and what may come.
Understood. Next question is a slightly lengthy question, so bear with me. We understand that gold is very much a macro play and a major portfolio diversification and liquidity tool. Does the World Gold Council analyze and examine managed money portfolio holdings, for example, the total managed money, including family offices, hedge funds, investment funds, and pension funds? The total average of portfolio diversifications into precious metals has been just over 3% over the last 70 years. It has at times been considerably higher, but the average falls in at around 3%. As of today, independent research has it at roughly 0.5%. Would you agree that a simple mean reversion back to historical norms would indeed require a wall of money to enter this asset class and therefore provide the catalyst for a revaluation of gold? Essentially, are you able to confirm that there is indeed a severe underweighting of managed money portfolio holdings within gold and overall precious metal space in general presently?
So it's a very interesting question. I think I can't speak to the research that you've quoted, but certainly from past research that we have done, we have found that gold tends to be under-owned broadly by the investment community. So the analysis that we did some years ago now, but found that gold made up less than 1% of all investable assets globally. So an incredibly small part. And we do speak to many of the areas that you referenced, so the family offices, institutional investors, pension funds. We have kind of continuous ongoing engagement with them, and that gives us some insight into the general portfolios that they have, how gold potentially does and does not fit in with that, and what a rough broad level that may be. What we can say is that gold ownership being lower, and our analysis combined with that, we tend to find that many investors may benefit from an allocation to gold, and in some cases that might be higher than they already have, but it could also be lower. We try to be quite objective about this. Now, what we tend to look at is kind of the makeup of the portfolio. That's incredibly important when we're talking about asset allocation, and gold in particular. It's always in reference to what the overall allocation is. Now, depending on what that may be, and what we have seen over the last at least 10 or 20 years, has been very much the strategy of the 60-40 portfolio, and obviously with that kind of 60% in fixed income with 40% in equity, and how that has shifted over time. Now, obviously, we've spoken a lot about the macroeconomic environment and how that has been evolving. We've had the unprecedented low interest rates, but now we're seeing inflation and potentially those interest rates rising. And what that has done is really we've seen shifts in asset allocation in recent years. Now, many of those are not seeing the return on bonds that they once did, that bonds aren't providing the hedge against equities that they once did. And that has led to many investors looking to alternatives such as real assets, or alternative assets, in order to supplement or kind of provide that return that they are not getting elsewhere traditionally, or traditionally have got in other areas such as bonds. And it's those kind of shifts that we have been monitoring more recently, that have kind of influenced our analysis and kind of our messaging in terms of gold, and how that may fit in. So obviously any shifts from asset allocations that were deemed safer to more riskier assets, which again, things like alternative assets, which can provide greater returns, also often come with greater risk. And because of moves like that and shifts like that into kind of more high risk assets, and therefore bringing up overall portfolio risk, has meant that our analysis has found that typically it might mean that there is a greater role for gold in portfolios as that hedge against increased portfolio risk. And that's something that we keenly look at. We kind of refresh our analysis once a year. So as I said, I can't speak to those precise numbers that you quoted, but certainly we found that the trends in portfolio asset allocation has led to the conclusion that we believe that there could be a greater role for gold in the environment that we've had as investors search for yield in higher risk assets, but also going forward with the rampant inflation that we've seen alongside those other assets I mentioned when talking about kind of inflation protection, means that again gold could still serve a very important role, and dependent on the makeup of the portfolio may mean that we might see the need for a greater level of gold or potentially a lower level of gold, but it really is kind of portfolio dependent.
It's probably worth just raising the report that we published last year in conjunction with Greenwich Associates. So we surveyed over 400 institutions, I think it was in the US and EMEA, and we did find in that report, it's called Reset, We Think, We Balance, it's found on our website, that I think average holdings of the people who actually had a position in gold were round about 4%, I think, or just a bit under, and also kind of reinforced exactly what Chris has just talked about, that there was an increased appetite to increase allocations or target allocations to gold, and it was those drivers of kind of risk-adjusted returns and diversification that was sort of at the forefront of the reasons for that.
Brilliant, that's very helpful. Before we wrap up, our founding partner, David, who spoke a little earlier, David Mitchell, would you like to add a few points or indeed some further questions?
Yes, thank you. Thanks very much, Louise. Thanks, Krishan. I really appreciate it. We do understand that you're walking on fine rice paper as far as politics are concerned. So there are things that you cannot really delve into. I think I hear, Louise, as far as the investors that have invested into gold have a reasonable risk-adjusted percentage of their portfolios close to 3-4%. However, looking across the market, it is actually considerably lower than that, and well below 0.75%, 0.75% that is. And obviously, even if we mean revert to 50% of the 70-year average, which is just up to 1.5%, would mean a tsunami of investment monies into this particular sector. I think from also a broad money supply and the massive increase really is not just from Greenspan days in the year 2000s, and he was very much an advocate of broad money supply increases, very aggressive broad money supply increases. But realistically, from the global financial crisis, broad money supply has increased exponentially, especially over the last 2.5 years. And gold has lagged. Gold has massively lagged. In fact, we can argue today that gold is incredibly undervalued, historically undervalued as of today, even at these lofty levels of $2,000. The trouble is that obviously money is being destroyed and debased. The only way for this somewhat message can be reversed, I would suggest, is, and as you brought it up earlier, that our central bank policymakers was to decrease their balance sheets and reverse QT, quantitative tightening. The trouble is we're in a global debt crisis, and that's physically, mathematically impossible. So I'm afraid our future lies in continued negative nominal yields. Historically speaking, from a cycle perspective, whenever we see the gold market enter a bull market, it is really not until the last 15% of that overall cycle do you see where gold plays a massive catch up. And I think this is a psychological trigger where the market suddenly realizes that gold is incredibly undervalued, and you see these large spikes higher. You saw this in the 2003-2011 market. You saw this in the 1970s market. You even saw this in the 1930s when gold was nationalized and investors moved into the gold mining sector as a proxy to holding physical gold. And it really isn't until that last part of the cycle where the investment money suddenly realize a diversification. I'm also happy that you brought up the 60-40 rule. I think on the other side of the coin at the moment, we've probably got closer to 60% in equities and 40% in debt structures. The problem is that moving forward, money managers are guaranteed losses holding bonds and debt structures moving forward over the next 10 years, 15 years. So there has to be a diversification of their portfolios. It's not really served them that well over the last 5 years. And I know that the bond market has continued to rally and rates have continued to fall, but from a money management and especially a pension fund portfolio stance, there is massive black holes in their returns. So there are massive shortfalls to be fixed. We've got continued negative nominal yields to look forward to, and gold is incredibly undervalued from the analysis that we tend to concentrate on. I understand a lot of that. You'd rather veer away from mentioning, but if you do have any comments, that's just a broad stroke on what I've just said, then I would very much appreciate it. Otherwise, I'll hand over to Robbie, and I really do appreciate you coming on. Thank you very much.
Any comments on that, Louise or Krish?
I think we just want to maybe take a moment to summarize all that we've discussed today. That I think, on the topic of outlook, I think, as Louise mentioned, we need to kind of consider the macroeconomic environment and how that will affect the individual sectors of the gold market and investment in particular, as David discussed and we've discussed. There are a number of factors going forward, and I think to kind of broadly categorize it as a lot of risk and uncertainty going forward in terms of what may play out. We are, as Louise mentioned, moving into a period, and David mentioned, a period of central banks potentially drastically reversing the policies that have been in place in recent years, and investors, the investors are keenly aware of that. So going forward and how this impacts gold, I think we kind of have to wait and see. We have those overarching competing forces of higher inflation and potentially now higher rates, and that's going to be instrumental to what we see influencing gold going forward. But we will have to wait and see how that works. And you know, I'd invite any of your audience who are interested to again to visit our website goldhub.com. We put out a research and insight consistently, and that's where you can get our latest thoughts on what's happening in gold in particular, and its role within portfolios and the kind of the financial world more broadly. So yeah, just again say thank you again for having us. It's been a great conversation.
One last note on every single rate hike cycle higher, gold has actually outperformed. Not only during the 1970s and when they stopped raising interest rates in 1974, 1975, and gold halved. It was when interest rates started moving down, and when they started hiking again is when gold outperformed. Again, we saw that in the 2000s, 2003, 2006, 2015 onwards, when they started raising interest rates, gold outperformed very dramatically. Why does gold outperform in a rate hike cycle, which is effectively what we're trying to enter now? It's because it's risk off and its diversification is required. And we've got a heady mixture of negative nominal interest rates. So moving into cash is not doable. Diversification and portfolio adjustment is essential, but cash is off the table and debt instruments is difficult. So gold becomes a very, very attractive story in a rate hike cycle.
Indeed. Thanks for that, David. Louise, Krish, many thanks for your illuminating presentations and for, of course, the continued great work done by the World Gold Council in informing investors in gold and investors across this hugely dynamic asset class of precious metals in general. We do look forward to chatting with you both once again, perhaps later in the year. But again, thank you so much for your time, and we will stay in touch. Brilliant.
Thank you very much.
Thanks very much.
Thank you.
Thank you.
Bye-bye.
Cheers.